In this video, I'm going to show you 3 strategies you can use to decide when is the right time to exit a poor man's cover call. First and briefly, what is a poor man's cover call? A poor man's cover call is made up of 2 option legs. The first one you see depicted here in our risk profile. You buy a long-term call option. Here you see an example of that. We're looking to buy the call option that expires in about 564 days. Now, if we just bought this call option, how would it make money? Well, here you see the risk profile of this call option. Notice that as the underlying stock price goes up, this call option has the potential to also go up in value. Now, the stock I'm going to share with you in this video is eBay. It's a stock I've been trading actively over the past couple of years. So we have step 1 of a poor man's cover call. What about step 2? Once you've purchased your long-term call option that typically expires in over a year, that's known as a leaps option, then you sell a shorter term call option against it. And here's what that might look like all by itself. In just a minute, I'm going to put these 2 positions together to form a poor man's cover call. But here we're looking to sell a call option that expires in 46 days. So 46 days to expiration. And notice the risk profile here. For selling this call option, if it remains above this area right in here, then you get full profit. And here you see that this call option will lose value as the underlying stock, in this case eBay, goes up in price if this was the only position you had on. But we're going to protect ourselves against that by owning that long-term call option that I just showed you. Now let's put these 2 positions together to form the poor man's cover call. And here you see details of this position. So we've purchased the January 16th $50 call option. Remember that call option expires in over a year. And eBay is currently trading right around $54 per share. So this option is in the money. And we've also sold the August 16th $57.50 call option. As you see here, that option expires in about 46 days. Anytime you place a complex option trade like this that involves more than one leg, you want to consider your Greeks. If you don't know what the Greeks are, I'll leave a video down in the description below that helps explain what they are. So I'm assuming you know what the Greeks are. So let's peek at our Greeks here to make sure they're lined up in our favor. Here you see the main Greeks at the bottom. The 2 we're going to focus on here are Delta and Theta. When you're doing a poor man's cover call, you want those 2 Greeks to be in your favor if at all possible. Let's first look at Delta. Remember, Delta is the estimate of how much this position will go up in value or go down in value for the next dollar that eBay goes up or down in value. Since we're bullish on eBay, we want Delta to be positive. And here you see that's exactly what we have with this position. Delta is 39.12. That means for the next dollar that eBay goes up, it's estimated that the value of this position will go up by just over $39. But since we're selling options, we also want theta or time decay in our favor. So notice what theta is here. It's 1.34. That means that for each day that passes, if nothing else were to change with this position, the value of this position should gain about $1.34. So we have Delta and Theta both in our favor. And this is a typical setup for poor man's cover call. But the question I'm going to answer in this video is, how do you know when to exit this position? So this is our position setup. When do we get out? Well, there's 3 times I believe you should consider getting out of a poor man's cover call. Let's first talk through when you should exit this position if the position goes against you or goes down in price. Remember, since our delta is positive, we like the value of the underlying stock to go up. So let's say it didn't work out that way. Let's say eBay began to go down in price. When might we exit this position for a loss? Here we see eBay's in a nice uptrend. I won't get too technical here because this isn't a technical analysis video. I just want to share with you an example of when you might realize that you're wrong and you need to exit for a loss. So we see overall eBay's been in a nice uptrend over the past several months. It's continuing making higher highs and higher lows. We find us in a position where it's riding this green 50 moving average on this daily chart for support. So the first trigger to warn you that it might be time to get out is if it breaks through that support. Now, it's done that in the past, but notice what happened. It found support at this upward sloping trend line that I've drawn here. So the question is, when do you know you're wrong in your assumption that eBay will keep going up in price? What if eBay were to break through that green 50 moving average and then break through this support line, that I might begin to realize I'm probably wrong in price? If it were to keep going down and be below this area of support that's around $49 per share, at that point I would feel very confident that the market did not agree with it anymore and eBay was no longer in a bullish trend on this daily chart. But you might even do that sooner. Notice that we have support right in here from this candlestick on June 17th. We also have support right in here from these candlesticks back on May 21st. So you might say if it breaks through both of those supports, it will have also broken through this white upward sloping trend line. And if that happens at that point, I'm out. So that's a simple strategy to tell you when you're out. You could also do a certain loss amount, but I prefer the technical exit because it tells you that you were wrong in your assumption. But now let's focus on the 3 times you should consider getting out of a poor man's cover call when it's going your way. Now we fast forward about 80 days to September 19th. We entered the position here on July 1st, and it's now here we see this down yellow arrow. Why might we consider exiting on this day? Well, besides the fact that it's had a nice run up, which is great because remember we had a positive delta. Our position should be making money. So how much money should we have made? You see the diagram of our P&L. Now first, let's focus here on the bottom. Notice our profit and loss is. We're now at a profit of almost $250 in this position. So that's one reason why you might exit a poor man's covered call if it hits your profit target. In this case, if we had set a profit target of $250, we might exit on this day. Remember, the position cost us $910 total. We have a profit of $247. So that's a really nice profit. So you can set a profit as a dollar amount or as a percentage of your overall risk. That gives you a really nice return on capital in just 80 days. So that's reason number one why you might exit this position. Let's move on to reason number two why you should exit. Reason number two is that the underlying stock reaches your target price. If you've been watching my channel for a while, you know I like to only trade in companies that I believe are fairly valued, or even better, companies that are undervalued. eBay has been a company that I believe has been undervalued for a long time. However, with its recent strong advance, I no longer believe that it's undervalued. In fact, I believe it's somewhat overvalued. Now, it doesn't mean the stock will just stop going up in price. It could continue to go up, but it's just not one that I want to trade in right now because I believe it's overvalued. But what might prompt us to exit this position because of stock price? Here you see I've kind of backed up about a week. We've now been in this trade for 73 days, and it's September 12th. And just so you can see where we're at on the chart, we're now right in here on this big green candle. eBay has just had a really strong, nice advance on this day. I notice the stock is trading for around $63 per share. Let's say we believe that was the fair value of eBay, or that was just the price we thought we wanted to exit at. Well, on this day, we could exit the position. And what would that profit and loss look like? Here you see with eBay trading for around $63 per share, we can exit this position. We realize a profit of about $229. Again, a really nice profit. If you run your percentage return, you'll see just how good it is. We realize a profit of $229. And remember, this position cost us $910. So we realize a return on our capital we had at risk of over 25% in just 73 days. That's a pretty awesome return. So that's exit trigger number two, when the underlying stock reaches a certain price. And for me, I like that to be when the stock reaches its fair value or close to it. You might also look at areas that might serve as resistance for it. And once it reaches that resistance area, then you might consider exiting the position. So that's exit trigger number two. Now let's move on to exit trigger number three. And this is the one I generally like to do because it lets my winners run. You probably heard that. Let your winners run and cut your losers short. Well, this lets your winners run. Let's see how we might let that happen with eBay. Now, with this position, we're letting our exit loss trigger be our Greeks. We're going back to those two Greeks I spoke about at the beginning, Delta and Theta. Remember, we prefer for both those Greeks to be going in our favor. So maybe we say we're going to let this position run until one or both of those Greeks are going against us. Well, when would that have happened with this position? Now, I fast forward to the point we've been in this trade for 80 days. That's on September 19th. Let's focus here on our Greeks down here at the bottom. Notice that Delta has now turned negative. It's negative $21. That means for each dollar the underlying stock eBay goes up in price, the value of this position actually goes down by $21. Well, we don't really like that. That means we're losing money. That might be the first trigger that tells us we might want to consider getting out of this position. But you might be asking, why is it losing money? We own a long call that's farther in the money than the short call that we've sold. And that's true. But the problem is you see here in this top left corner is that short call options we've sold, its delta is very high. So basically, if the next dollar that eBay goes up or down, the value of this short call option goes up or down because it's so close to expiration. It's only 1 day to expiration. Whereas the call option we own, its delta is a lot lower than 1 or 100 for the entire position. So deltas have turned upside down on us. They're actually working against us. And here you see that represented in this risk profile. This is what would happen if the stock goes down to the left. This is what happens if the stock goes up to the right. Notice if the stock continues to go up, our profit and loss continues to go down. So we don't like that. But the other Greek you want to keep an eye on is Theta. And notice that Theta is actually red here. That's because it has turned negative. So we have Delta working against us in a bullish stock. We have Theta working against us. To me, it's time to get out of this position. Knowing when to exit a poor man's cover call is a vital piece of being a successful long-term option trader. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Knowing when to close out a poor man's cover call position is a vital piece of successfully trading in poor man's cover calls. But there's a lot more that goes into successfully trading this unique strategy. If you'd like to see more of my tips and tricks on how I trade poor man's cover calls, check out the video series at the link above and the description below entitled Poor Man's Cover Call and Leaps Option Trading. Until next time, happy investing, and we'll see you again soon.